of you are on telephone, and I know you don't have the ability to see it, so let me read this for you. The information provided in this webinar and any supplementary materials provided to registrants are intended for educational and informational purposes only and does not constitute professional, legal, or financial advice. No registrant should act or fail to act on the basis of any material contained in this webinar without obtaining proper financial, legal, and other professional advice specific to their situation. The Northern California Small Business Development Center and its host, the HSU Sponsored Programs Foundation, specifically disclaims any liability, loss, or risk, personal or otherwise, which is incurred as a consequence directly or indirectly of the use and application of any of the information presented in this webinar. And I want to share with you, there's a lot of information to cover today. We have a chat box where you can place your questions. If you don't want to turn your mic on and ask your question directly, you are welcome to turn on your mic and ask a question. Both Joe and Joe will let you know the right time to do that. We are so glad you're here. Thanks for joining us. And I'd like to introduce you to Joe and Joe.
It's the JoJo Show once again, huh?
Yeah, welcome.
What a team. What a team. Let me find my cursor. My cursor went away. Always exciting when that happens. All right. Then again, we are a nonprofit organization, provide confidential one-on-one advisory meetings and trainings. And this is, of course, one of those. Thank you all for paying your taxes along with us. We are paid by the SBA and a California state group called GoBiz. I'll kick things off today. Joe Rodola is my name. I'm the lead advisor here at Cascade, the Shasta-Cascade SBDC. This particular webinar is prepared with the Shasta County and Trinity County population in mind. So if you are coming in from outside of our geographic area, the majority of this information will make sense, okay? But some of it might be a little different depending on the county in which you reside. There are SBDC offices everywhere in the US, and we cover all counties and all cities within that geographic area of the United States, including Puerto Rico. And so you can get us, and we all offer the same types of services. As you can see here by the information, I'm an old credit guy. So that's my background. We also have a huge list of other specialists within our organization, okay, of which you're talking to and meeting several of us today. So we have David Walker as our center director. Emily is our right arm. She's the one who helps us get information and set up appointments. We've marketing advisors, QuickBook advisors, tech advisors, web advisors. Linda is a fantastic small business coach. And we even have a tech startup and HR capabilities and restaurant specialists. So all of our services and all of our consultants, again, no charge. All right, so what are we doing today? We're going to figure out what type of entity your business is going to be, okay? These are kind of the, I like to say we're covering the overall basic options here, all right? You can get into nuances as Joe also told me this morning in LLCs, but suffice it to say, we're going to cover all the general pieces of setting up an entity for your business. And we're going to start with fictitious name. By the end of the course, you'll understand fictitious name, hopefully make a decision on what structure you want to begin with, and of course, how to make changes to that as your business grows. So let's start with fictitious name. What are you going to call this thing, right? So there are options. There are options, okay? What name is the meaning of your business? Does it personify your personality? Is it easy to recognize? Do you want name recognition? In what ways do you want name recognition? What's your logo going to look like, and how is that going to be represented in the name? Is it your name, or is it an abstract meaning? And of course, if you do not want to go through this particular, what would you call it? Kind of a thorn, a money cost to your business startup, use your surname. You don't have to worry about this at all. Okay. How do you get fictitious names started? Right now during COVID-19, everything's being done, of course, over one of these computers, right? So here's the Shasta County link to the website to go right on to the County of Shasta, and you can go right to the fictitious business name section of the website. Takes you right to it. Full explanation on how to go about doing the fictitious name. I'll give you an idea of an example. I have a side business, okay? My business is called Joe Rodola's Debt Consulting. Joe Rodola's Debt Consulting. So guess what? My surname, Rodola, is in the name of the business. Okay, I'm with sole proprietor, pretty easy, pretty clean. Used my surname in the business. I don't have to go through this step, okay? So currently follow the steps at that website, fill out the application online. You'll pay a little fee, okay? And then you'll be able to publish that information in the newspaper, and they give the name of the 3 papers right on the website that you can put them in. One being, of course, the Reading Record Searchlight. Okay, there's three paper options. The paper will publish it once a week for 4 weeks. That also then delays, right, the times technically that you can have this name attached to your business, because you have to let it run. So you have to let it run those weeks. And then you can proceed after that particular step is done, and then go get your business license, okay? What's cool about not having to go through this process is, as in my case, I decided, I believe on a Tuesday, that I was going to start my business. And by the following Tuesday, I was already open and ready to go. So, you know, you can, in certain cases, start a business, especially a small service business like mine, in a matter of days if you do not have to use this fictitious name process. What would my business have been if it was fictitious name? JR Debt Consulting, easy way to actually give you an example. If I went JR's Debt Consulting, that's fictitious name, right? So I would have had to go through this step. The total cost of getting this done is about $150 plus or minus, okay, to get this step accomplished. Okay, do we have any questions so far?
Feel free to turn on your microphone if you'd like to ask a question, or you can put one in the chat. I don't have any in the chat right now. I did have someone earlier ask for a recording, and I let them know that Emily will share a recording of this webinar in a couple days through email.
I had a question. I think I sent it to Joe directly. I should have sent it to you, Linda. Sorry. If we're buying a existing business, I'm guessing we don't have to do the fictitious business name part, right?
If the name's staying the same, the only thing you'll have to do is change ownership, as far as I know.
Okay, thank you.
Thanks.
So we did get a question. Is fictitious name something like DBA?
It's separate from. It's separate from. The whole idea of fictitious name really is that surname, using your surname in the business name. So it's different. It's different than DBA.
And another question is, can we skip the fictitious business name if our name is in it, like in an LLC?
I think, Joe, if you don't have to file fictitious if it's like, if I would Joe Rodola's LLC or Joe Rodola's Debt Consulting LLC.
Yeah, I think the fictitious business name, one of the things that the benefit is you're allowed to actually open up a business account at a bank.
Yeah, exactly. Exactly. And allows you, of course, to get your business name correct on their business.
Yeah, so if somebody writes you a check personally, but it's for business, you want to make sure it goes into the business account. They may have cashing that.
That's true too. And when you come in to individually meet with us, we'll be able to also kind of hone in on where, on your particular situation a lot more easily once we know exactly what you're doing, okay? One of the things that this offers and allows you obviously to do after you sign up for our service is come in and say hi. Well, or Zoom hi. Right now we're Zooming hi. But one of these days we'll be able to actually come in and shake hands again. I can't wait. It's killing me. All right. So here we go. Legal structures. We're going to start out with sole prop. We're going to end up at corporation. So what entity is right for you? Really depends on what type of business you have. That's one of the best ways to start. Okay. A service business, you're the only person that's running it. You don't have any employees. It's just you. Like in my particular case, don't do it, Lord. I'm not ready. I got more fish to catch and more islands to visit. But if I passed away today, technically my business ceases to exist. It's over. Okay. So it's a sole owner, sole proprietor. That's what it's called. Okay. So that's the easiest to set up. So do you need ease of setup? Do you need protection of your personal property? How much paperwork you're willing to do? Okay. This corporation is going to take some paper. How much do you want to spend? Each one costs different. And how quick you want to get it going. Because it takes a little longer when you have to, cross T's and dot I's to get the paperwork together than in my case where I opened within a week. Okay. And again, you want to get started doing it all yourself. Corporation, I don't know about Joe Dorko's beliefs, but you really need some help in setting up a corporation. So, all right, so sole proprietor, what's the positives? Easiest to set up by far, okay? Easiest to set up. No major league paperwork except fictitious name. There really is nothing else you need, okay? Least amount of paperwork because you just basically walk in. In my particular case, I went to the city at the time. Right now, you can't walk into the city. City offices are closed. You got to do it online. But suffice it to say, downtown Reading, 3rd floor, all the way to the left is where you can get your business licenses. So I walked in there and said, just sat down and filled out some paperwork, paid them some money, and got my business license. And it's very clean and easy. It is, though, the least personally protected. All right. In other words, somebody sues you and you're a sole proprietor, I guess technically they could go after my boat. All right. Lowest cost and time again, and normally great for startups. Okay. Especially service businesses. And no matter what you do in the sole proprietorship situation, you should have strong business liability insurance. One of the things that I had to do when I opened Joe Rodola's Debt Consulting, because I was teaching classes for the city and the county in the local area, their biggest glitch was to pay me to teach the classes. Gee, Joe, you have to have $1 million liability policy. That was really why it took a week to open, because I wanted to get the policy in place prior to going in and getting the license set up. But suffice it to say, I called my insurance company, said, hey, you guys do liability insurance for business? Because I had never done this before. And they said, sure. And set me up with $1 million policy. At the moment, as a sole proprietorship, just my own personal situation, I'm running $1 million liability policy for the business. I operate out of my house. No clients visit me at my home. All my classes are taught off-site. Okay. $1 million liability policy and $1 million personal liability umbrella. So I went $1 million. And in my particular case, since I'm teaching and talking and telling people stuff I know, it's fairly inexpensive. It's $60 a month. So it just depends on the risk involved in your business as to what those costs for liability insurance will be. And I always suggest you start with your regular insurance company first, because then you get a package deal, right? Because, in my case, State Farm, although they're a fairly expensive company, they cover my house, my cars, my boat, and my business. So you get a package. What is a sole proprietorship? Normally single owner. You are the business and the business is you. Easiest way to describe it. You can set it up quickly, as I mentioned, using your surname in the business. You can set it up right away. Technically, I could have gone in the same day I decided. Cheapest to set up, again, because you don't have a lot of money you have to spend setting it up. Okay, there really is no setup when you go to the city to get your license. You just pay the city license fee. More liability if sued again, and of course, ease to change when the business evolves. So if I ended up wanting to open Joe Rodola's debt consulting offices throughout the United States, I would have evolved from sole prop up to corporation. See, because liability increases, it becomes a franchise. You get the idea. All right, so what's the next step? Partnership. What's a partnership? Still pretty easy to set up. There's a little more paperwork involved, okay? Still not personally protected in case of lawsuits, and it's more than one person. So if I had a buddy or someone else that was going to do certain portions of my business with me, including maybe helping fund it, which happens quite often, then that would have been a partnership. Okay. Normally need a partnership agreement, obviously. And those can be as simply done as pulling one off of a pre-printed partnership agreement on the computer. You can look them up. There's lots of them. Okay. And the partnership agreement basically says who's responsible for what. And you can actually split percentages, if you wish, of profits involved as well. So maybe it's a 60-40 or a 50-50 percent profit share between the partners. Okay. A little more cost if you have it professionally prepared. Great for startups with more than one owner. And of course, you still got to have a lot of liability insurance, right? Because you still got to protect. In my case, it would have been protect Joe and his family, Joe Rodola and his family. Partnership is a little bit more intensive. We can assist with that. We can even guide you through getting a couple of free partnership agreements that I've seen over the years that people have used. So it's just normally a place where you can go to set up with more than one person involved. Basically what a partnership is. So two or more owners, okay? Who's going to do what? You can actually lay that out. Sometimes I know I was involved with a partnership that kind of converted into an LLC. And one guy was the tech side and the other guy was the sales side. So they had a product. So they had somebody that was making it and working with it, and somebody was selling it. So that's how they decided to split it up. Okay. And again, the income's passed to the partners. Personal liability is still high. Partnership should be made. Liability insurance is a must, and a little harder to set up in sole prop because you got to do a little bit more paperwork. Okay. All right. Do we have any questions at this point before I pass off to Joe?
We do. I have a couple, Joe, and they're more kind of clarifying questions.
Yes.
Let me go back in my chat here. So fictitious names are used when you are a sole proprietor and not using a legal structure?
Fictitious name is used in all cases. It's used in all cases. It just is a decision-making factor as to whether or not you want to use your surname in the name of the business or not. You know, I mean, like if I went JR's debt consulting, it would have been a step I would have had to have taken before I got this license and told the cities what type of business I'm going to be. See, it's a pre-step. The business name is a pre-step before you actually make these decisions. You can, in some cases, because LLCs take longer, and Joe will explain that to you. Some cases you can start the process of fictitious name filing and start the LLC kind of simultaneously if you want. Especially if you know there's no, see, here's the catch. If I wanted to set up JR Debt Consulting and there was JR something else in town, they could squawk. That's the whole idea of fictitious name filing. You're telling everybody in the community in an old-fashioned way, newspaper, you're opening a business under this fictitious name, this no surname name, JR's Debt Consulting. So if there was JR Credit Repair somewhere out there in Reading, Shasta County, and they saw that and said, no, Joe, you got to change that name. That's what it's for. That's what it's for, okay? Telling people that you're opening this business and they can dispute it. People out there could dispute it. So that's the idea of fictitious name filing. It has nothing to do with whether you open up a sole prop, partnership, LLC. That's all decided based on really what you're doing.
And Joe, there was a question on a previous slide where you had a link that people could look at for the fictitious name process.
Right.
Could you jump back to that slide?
When we send you the slide, but
yeah, those, if you have a
I'll do
telephone, you can take a quick picture of that link.
yeah, there you go. It's the Shasta County website's what it is. So it's CO period Shasta period CA period US. That'll get you into the county website. Just put Shasta County and it'll take you to the site. Then it's index/clerk/fictitious business name. And there's what's cool about getting to that particular page is obviously it's got the form, a link to the form to fill out. Okay. And exact steps what to take after you fill out the form and print it. So it's really, really cool. It's a one-page explanation and it tells you exactly what to do step by step.
And Joe, the last question we have currently is, can a sole proprietor be a married couple?
I tried to look that up. Some people said it was allowable because we're something about state of California and community property, but I couldn't find where that was suggested. That was always suggested in the information I was able to look up that really is a partnership. And I can tell you one thing that has come up during this, especially now with the COVID-19 CARES Act stuff, the grants, the loans, you name it. If you're a veteran, if you want to become a women-owned business, if you are a minority by category, you want to be 51% owner of that business, not 50-50. Okay? Why am I saying that? Because priority. The state grant right now is giving priority to veterans, disabled veterans, women-owned businesses, and minority-owned businesses. Okay? So if you're 50-50, what are you? Right? So as far as I'm concerned, have one person that's the majority owner and have the majority owner be the one that's got the bells and whistles. All right? So if you're a female minority that's a veteran, dude, that gives you all of it, right? And nothing to be said, but you have to think wisely as to how things happen. And with this disaster, we found out right away that, if you were 50-50 and well, he's the veteran, I'm not the veteran, or I'm 60% owner and I'm not the veteran, but I have a 40% veteran owner. That became an issue. Okay. So my suggestion is partnership. And then if it's a husband and wife and that's all the difference there is, put your wife as the majority owner. That makes sense. Okay. Because then you got a leg up on all things that happen. And who knows where this is going to end up as far as COVID goes.
That wraps up our questions, Joe. Thanks.
Thank you very much. All right, with no further ado, I'd love to introduce the second half of our Joe Show, Joe Dorko.
Good morning. My name is Joe Dorko. I work with the SBDC, and I also have another business like Joe does on the side, that I'm a income tax preparer. And I also help do some business consulting and helping people set up their LLCs. So that's kind of one of the things that is one of my expertise here. So let's just go ahead and jump right in. What is an LLC? An LLC is a limited liability company, is a type of business entity that a company can form by filing paperwork with the state. An LLC can have one owner, known as a single member, or it could have multiple owners. And LLCs are what they consider a pass-through entity, meaning it's an entity in itself, separate than it's like its own sole proprietor, so to speak. However, it's not taxed, so all the net income from that business actually passes through to the partners or the shareholders as a percentage as defined in the opening documents. And so that passes through to several different types of forms. It just depends upon how the actual LLC is set up. And there's multiple different ways with the LLC, what can be set up, where you're, like I said, a single member, or you can have multiple owners. And you divide the income or expense or loss, and you pass that through to the owner's personal taxes. And then moving along here, the word limited liability refers to the fact that LLC members cannot be held personally responsible for business debts. So in a dispute with a business creditor, members may actually lose money invested in the company, but their personal assets are not at risk. For the most part, there are a few situations when that can actually change. And that is if you've actually did something intentionally just to, say, for example, you were the LLC was being sued for something you did wrong, and then you took all your personal assets out of that just to withdraw it right before the lawsuit. Sometimes the courts will see through that and actually come after those assets that were originally in the LLC at that point when the negligence occurred. Okay, so if we go to the next slide, LLC continued. LLC members also aren't usually liable for co-owners' negligence or wrongdoings in a business. So like if you have something that's defined your role, and one of the partners in their role does something illegal, usually it's limited to that one person's percentage of the liability. So if you have 100,000 in assets in the business and it's a 50-50, and the one partner did something illegal, say did some fraud, they would only come after 50,000 of the business in theory, depending upon how good of an attorney you have. We're gonna speak in theory here. Corporations also offer liability protection, but sole proprietorships and partnerships that do. I'm sorry. Let me rephrase that or re-say that. So LLC memberships aren't usually liable for co-owners' negligence or wrongdoing in business matters. Corporations also offer this liability protection, but sole proprietorships and partnerships do not. So there's kind of the difference in between there when it comes to liability. Now, LLCs and S corporations, they are pass-through entities. That means the income is passed, or expenses or loss is passed to the shareholders. LLCs have a lot of versions of them. I will go into a couple of those, kind of the ones that mostly apply. So like the first one we're going to look at is usually your single member LLC. And that is basically almost a sole proprietorship, but you do have the protection of the LLC. Your actual income passes through to a Schedule C. And usually it's just one shareholder, or you can actually have a husband and wife in this partnership, but it's considered still a single member because you are married. And again, the income flows to the Schedule C. All the assets of the limited liability receive the protection of that. So they cannot come after the personal assets on this type of setup also, or business structure. So if we go to the next slide. Okay, so 2 general partnerships. When an LLC is formed with multiple members, a general partnership is the preferred structure. This means that the owners take responsibility for the transactions, debts, and taxes from the business. Each member can also determine when assets are sold, and he or she pays taxes on his or her business income share. Typically, this is actually, the forms that we're going to file here would be the form Irs Form 1065. The state has I believe it's a 568. Again, it is a pass-through entity, and how they usually distribute the income and expenses is on a K1 form, which is basically, it's almost, in essence, think of that like the W-2 for the members. So it shows what type of income they are receiving to put on their personal tax returns and pay the personal income tax on that. Okay, if we can go to the next slide, Joe. All right, continuing here, then you have what's called a family limited partnership. Basically, these are a way for families to put assets in there so that it goes into its own separate entity, but the family still controls it. But it's a nice tool for using if you say you're getting a little bit older and you don't want and you have enough assets that you don't want your children to have to pay the estate tax. This is a common way to help avoid some of that taxing because the estate tax can be pretty high a percentage. So like I said, it's very common use for estate planning. But you can still run any type of business in that, but it just really passes the assets down as an inheritance. All right, next slide. Okay, so then the next pass-through entity I'd like to talk about is the S corporation. The S corporation is, in essence, an LLC that has elected to be taxed as a corporation. And again, the actual corporation does not pay taxes, but it does pass through all the taxes, or all the taxable income to the members of the corporation. One of the big benefits between this and a single member LLC is you can kind of designate what you define the income as, whether it be active income or passive income. Active income would be the equivalent of you going to work for somebody, paying Social Security taxes on it, or like a W-2. However, here, if you actually participate in it, you're going to pay yourself either as a W-2 or you can almost 1099 yourself through the K1, meaning that you're going to actually put some of this income as, and you'll actually have to pay employer's tax on that, which is about a 15.3% tax on that. So a lot of S corps will actually designate 2 different types of income. Part of it will be, and the way I like to describe it, is investment income, which they call ordinary income. That goes usually on line 1 on a K1. And that's more, think of that more like you invested money into a corporation. Say you bought stocks in the stock market. You don't pay the self-employment tax on anything you earn there. It's more of an ordinary income if it's a short-term gain. So you don't pay, you only just pay ordinary income, which goes onto your personal taxes, straight onto the 1040 via a few other forms. So when you separate those out, you can basically take and pay yourself what's a customary wage for somebody that would basically be hired to do the job. So in essence, your corporation hires you as an individual to run the corporation, and they pay you as an active employee that puts in, let's say, probably more than 750 hours for the year. So you can kind of split your income in two different forms. And it's really more of a tax savings plan for the ordinary income where you're not paying that 15.3% additional tax. And like I said, owners can work for the S Corp. They can be employees, while the LLC owners are considered more of a self-employed. An S Corp owner is more considered of as a investor and potentially a W-2 employee. All right, so if we go to the next slide. Okay, so the big question here, how do I know which business structure is right for you or right for me? I have a lot of people that come to me to ask me, hey, I'm setting up a business, Joe. How would you recommend I do this? I've got all kinds of advice from all kinds of people that say, you need a C Corp, or you need an S Corp, or you need an LLC. Don't go to loan as a sole proprietorship because there's too much liability in it. Well, there's some truth there, but what I like to do is I like to sit down and find out, what kind of assets do you have? How much personal assets do you want to protect? Because there is a lot of costs with moving to an LLC or an S Corp. If you have absolutely nothing to protect, let's say you've got $200 in your personal bank account and your car's a 1972 beat up Ford, you don't have much to protect. So why would you spend all the money it costs to set up an LLC or an S Corp, plus all the compliance that goes with it? Separate tax forms, the franchise tax board fees that are, the franchise tax board fees start out at a minimum of $800. That's per year. Plus you actually have to pay somebody like me to put together your tax returns, which there's a state and then there's a federal return that goes with that. I'm pretty cheap on my fees for that, but the average fees, they start at $600 and go up to about $1,500. That's the average cost per year you're paying a CPA to put taxes together just for the corporation. So you add the $1,500 plus the $800, and then the setup fee can be, if you hire an attorney to do this, they charge anywhere between $1,200 to $2,500 just to set this up, and then they charge you a annual fee to kind of manage that. So you can see that it gets really expensive. So again, getting back to my example, if you got $200 in the bank account, I personally don't think you need to spend the money there. And then let's look at other scenarios. Let's say you've got $50,000 in the bank. That's quite a bit of money, but it's still not life changing if somebody sued you. So my thought on this is, if you're going to spend between $1,500 to say $2,300, $2,400 a year just for the protection of the LLC or the S Corp, limit the liability to the assets of the company, why would you not just go out and get a big liability insurance policy that protects you? Like Joe says, he pays about $60 a month for his $1 million policy. Now, we look at the industry specific to see how much coverage I recommend. I recommend between $1 million and $3 million is what I usually recommend. And I also recommend that you actually buy into some type of a terrorist rider and a business loss rider. That if for some reason that you get shut down due to something outside your control, say terrorists attack a city and it's locked down, and it happens for quite a while and businesses are shut down, you have loss because you can't actually do business. So the business loss insurance pays you for your lost income. So those are, I think, better places to spend your $1,400 to $2,300 a year. Plus, you actually protect the assets of the LLC or the S Corp too. So if you do get sued, you actually protect those there too. So I think it's a better way to go if you're a smaller business and you're in an industry that's not so risky, so to speak. So you want to look at what do they personally sue you if you were negligent. And again, your attorney's probably going to be your best outlet to tell you what kind of potential lawsuits you could face. With any business, the way I describe this is, it's not if you're going to be sued, it's when you're going to be sued. And the majority of the time, you're not going to be at fault. But in this day and age, it's not about saying who's right or wrong. It's saying how much is going to cost me for this to go away. And you actually have to factor that in as part of doing business. let's say you are a mortgage company and you started a mortgage company. That is a high risk business because, you know, you do something illegal or wrong and somebody's looking for a $750,000 mortgage and they don't get the mortgage they were supposed to get. You're liable for $750,000 at a minimum, plus throw in another $50,000 attorney's fees. So you kind of want some protection there. But let's say you're a painting contractor. What's the most damage you could cause somebody as a painting contractor? You know, you could ruin something. Maybe you did something so extreme that you caused a mold, something to mold. Yeah, that could be $100,000. That's not the $850,000 that we're looking at in the other example. So you got to evaluate your need versus the cost of this. And there's a step in between the sole proprietorship to the LLC. And, you know, you also want to look at your growth. Do I plan on making, you know, a couple $100,000 a year? Well, once you've gone into that threshold, LLC and S Corp being taxed as an S Corp, in my opinion, it makes sense because you could pay yourself a W-2 on $50,000 worth of income and call it ordinary income on the other $150,000. You're saving, you know, 15.3% on $150,000. That adds up pretty quick in taxes. So, like I said, those are the things that you need to consider when you're actually figuring out what type of structure that you want to start with. And the majority of people do start off sole proprietorship or partnerships. But like Joe said, you really want to cover yourself there because you limit your coverage on personal assets. So you really want to look at the step in between there, which is the liability insurance and the proper coverage. And another important thing is go with a reputable company because an insurance company is only as good as their payout of their claims. If they deny your claim, you're still stuck there with the negligence or the lawsuit. So don't go with a buddy's uncle's liability insurance that you've never heard of before, or they're not backed by a large corporation. So those are things to consider. So I know I've kind of given you a drink from a fire hose here, but the good news is that people like Joe, me, and other people here at the SBDC, we are here to actually, you know, customize this and walk you through this and coach you through this process. And we don't charge anything directly to you. We are able to get our funding from the state and the SBA, and that is how we're able to offer no cost to you. I don't like to say it's free advice because it does cost something. But we are here to help. We're very knowledgeable, and we encourage you to take full advantage of the services that we do offer.
Joe, we do have a question.
Mm-hmm.
The question was posted before you went into the detailed explanation, so you've kind of touched on it, but it's a conversation worth having. Is it easier to start as a sole membership and convert to an LLC later?
It is easier to start as a sole proprietor. Like Joe said, let's look at the cost first. That's about $150 versus to start up an LLC or an S Corp. If you're not really that savvy and don't understand, what you're required to do, and maybe it overwhelms you, you've got to pay somebody like an attorney. Attorneys aren't cheap. One of the toughest things about a business startup is cash flow. Cash flow is a big thing. You want to pay attention to that because if you spend all your money trying to get set up, you won't have any operating money. And, most businesses don't make money for the first 18 months. 18 months is usually the critical part of a business because one, you've got to get your name out there. Two, you're working out the bugs in your system. And three, there's a lot of initial investment you need to put in there. If you have to buy a lot of equipment, that costs money. It usually costs a lot more money than you expect. So where can you save that money? I think it's in, the setup of your business. And when you grow to something that needs an LLC or an S Corp, then you have actually enough cash flow to actually afford to pay for all the, the correct setup. So that's kind of how I would recommend most people start is sole proprietorship or a partnership, depending upon if you have partners.
Joe,
But you
there's a
definitely want to
question.
cover yourself.
There's a question. Can a family-owned business be a sole proprietorship?
Like Joe was saying, technically we think it can, but it sounds more like a partnership because family can sue each other. And you know, there's an old saying that you don't do business with friends and family. There's a reason for that. It's not because you can't work well there, but when things go wrong, if you sued a perfect stranger or you guys split your ways, then you split ways. But your family, you have to see them at Christmas. You have to see them at Thanksgiving. You know, and that's with the partnership, you have agreements drawn up, and it'll sting for a little bit if you do sue each other. But when you cool down and calmer heads prevail, you look and you say, in essence, yeah, looking back on it, we did put that in writing, and that was right. I'm not happy about it, but you were correct on it. We did what we did when we originally set this up. So there's benefits there.
There are a few more questions. One thing I want to mention, because someone asked about, well, how do we reach you? So stick with us, because we do have a slide at the end of the presentation that lets you know how you can connect with us. So we will get to that in just a moment. Thanks so much for asking. Another question, Joe, is can you always change from sole proprietor to LLC?
Yeah, you can morph that in there. You're actually, it's pretty common. A lot of people do that. However, you are going from your business entity of a sole proprietorship where you basically commingle the business with your personal life. You're actually morphing that business into a whole separate entity. However, you keep the name, and it's still the name recognition. You keep the name. You just change the structure with either the state or the IRS or both. Because there's the single member LLCs, you actually still treat as a sole proprietorship for taxing issues, but you do receive a little bit of the benefit there for the LLC protection. So it's easy to morph into it, but you actually have paperwork you have to file with the Secretary of State and the Franchise Tax Board. So there's extra work to do that, but it's pretty doable.
And just something to mention to folks, the slide is up right now. Our office serves Shasta and Trinity counties in California. So if you're on this call and you are in that area, then we are the right place to reach out. And we have Emily's email there. And there's also a link to our website. If you're in a different county, all the counties in the US have an SBDC office. If you're in a different county, notice that link on the bottom, americassbdc.org/find-your-SBDC. And that's where you find the one in your area. Normally, we're doing this in about 5 minutes from now. So we're still doing Q&A. So please don't depart us yet. We have more to cover. It's just that seemed like something I wanted to make sure you understood. And there is a specific question for you, Joe. It says, I'm starting a startup and plan to register it soon. I do not have a board of directors to incorporate at the moment. If I register an LLC, may I convert it to a corporation later?
Yes, you can convert that into a corporation later. Most states, specifically here in California, there's usually you sit down, you have a board member meeting. You're required to have a minimum one. You have to take some notes on that. You have to record the notes, and you actually file those notes with the state. I think they're more considered like an articles of organization. And what you spell out in there is ownership. Majority of that stuff is you're spelling out ownership, you're issuing stock. It's more of a private stock. It's not one of those that you put on the stock exchange or anything. And you still consider it a private company or private stock. You could turn that into a C Corp even in the future, where you issue stock and raise capital to grow your business. But most small businesses don't go that route until they probably reach over a $10 million threshold. but yeah, it's easy enough to do. And quite frankly, you know, if you just call and talk to Joe or me, we'll be able to point you in the right direction. You know, and you know, it's also, you know, another good resource is the Secretary of State. I know I'm originally from Ohio. I set up a corporation in Ohio, and that the Secretary of State there was just as helpful as the California Secretary of State. These people sit around at their office, and I kind of almost think that they don't have much to do. So they sit there and read, and they know their product pretty well, because I've called them several times to get their take on different issues, and they are very knowledgeable also. So, you know, I found them really helpful. They're able to provide you with all the forms you need to do if you want to do this by yourself. You know, like I said, if you partner with us, we can help guide you through it, relatively less expensive than hiring an attorney.
Here's another question is how to change ownership in an LLC from 50-50 to 25-75.
Well, you know, again, I think I would do additional meeting and amend the articles, because that's your legal documentation that if somebody at the end of the year disputes the percentage you're supposed to get, you know, I recommend that you do that. I know a lot of them don't, but a lot of these LLCs and small partnerships or small shareholders or just a few partners, usually they're in agreement. But again, you know, if you have it in writing, there's no arguing that in the future. If it's not in writing, you know, you get into, well, you said that, and it's no, I said this type thing. And so it's best always to have it in writing and have it filed so that you have third-party proof, time-stamped, what has changed.
And is that just on paper, or does he need a form to fill out?
No, most of your minutes, I mean, you know, I jokingly say you could actually do it on a bar napkin if you wanted to, but it would be best probably, I would recommend you put it on your letterhead and everybody type it up and everybody signs dates and agrees to that. That's more formal. And, you know, I'm not an attorney, but I don't know if you need an actual witness in the state of California, but the more you have, the better off you are. So I would even encourage you to get a witness, an independent party that witnesses the signatures.
We have a number of questions. I'll keep going here. This one is, if I were to open a sole proprietorship in recent months, would it be qualified for the Small Business Relief Fund?
The Small Business Relief Fund that just came out, I believe you had to be in business by June 1st, 2019.
That is correct.
Yeah.
Yeah, so a business that's been opened a year and a half ago.
And we need to be able to provide proof when the easiest way to provide proof is your 2019 Schedule C.
There you go.
Okay. When you change your business structure, the fees would apply every time you apply to change it. Is that correct?
So the setup fees are the part that if you change that, they may not charge you as much if you come back as a repeat customer. But the fees, there are certain fees for changing with the county. The county does have recording fees and stuff like that. But they're not too hateful. I think they're reasonable, maybe a couple $100 max. So there are going to be some additional costs, but it's, you're not talking $3,000 or $4,000 or $5,000 to change into that different structure. The Franchise Tax Board, whether you're a single member LLC or an S Corp, you still pay that minimum $800 franchise tax fee on an annual basis. But if you start, and I think it's when you get over about 225,000, 250,000 in income, they start taxing you above the 800. The 800 is a minimum, and they base it on the type of business you are. There's a percentage of your, it's either net income or gross sales that they charge you upon. So when you do grow, there can be additional fees that way.
So we are just about at the end of our session. We have one last question to wrap it up. It's if you set up your LLC or sole proprietor in one state and later you move to a different state, is it easier to move your business accordingly, say for moving from California to Texas?
So if you set up, say, in California and you move to Texas, I'm not familiar with Texas's policies, but Texas seems to be less regulations. So it's probably going to be pretty easy transition. You just need to register with their Secretary of State that you're going to do business as an LLC there. Now, if you're not going to be doing business in California anymore, I recommend you do a final return and you file the paperwork to cancel your LLC. And you need to cancel with the Franchise Tax Board and the Secretary of State. And you need approval done by the end of the year, or you could potentially have to file another tax return and pay another $800 minimum to Franchise Tax Board. There is a couple scenarios where they will actually do a, if you never did business, they may waive that $800 fee. So let's say you set something up in California, but you never did anything in California, you never had any income in California, no open bank account listed for the California LLC. They may waive that $800 fee, and you just got to file a couple forms. That is something new they opened up at the end in the middle of last year, I'm sorry, it's 2021, in the middle of 2019. They opened up something like that for people that opened an LLC but never did any business. But if not, you still will need to pay the $800 fee, whether you had it open one day or you had it open all 365 days.
Great. Well, that wraps up our question. Joe Rodola, let's bring you back in. Any closing comments, Joe?
Well, thank you very much for attending. This is our first attempt at this particular webinar. So we will be sending out a evaluation form with suggested ideas of what else you would like to see in this particular webinar. Please check our website and NorCal SBDC's website. We have a ton, literally a ton of webinars going on, okay? Today at 11, for instance, is the wrap up of the first round of the state grant that was alluded to earlier in the conversation by one of the questions. The first stage is going to end tonight at midnight to get your application in on the first go round of that particular grant. Great 11 o'clock webinar on that one. So we have webinars just happening all the time. Please check those out. Again, they're at no cost to you. And thank you very much again for attending.
Joe Dorko, any closing words for you?
I think Joe kind of covered most of that, other than, again, we're here to coach you through this. We are not attorneys. So we're able to guide you, coach you through this. But if you do not understand anything, maybe it is time to, contact an attorney just to make sure that you're doing things properly in the setup. But like I said, we're a good resource, and so is the Secretary of State.
And for those of you that are looking to meet with one of our advisors, we do advisory sessions just like this over Zoom. So you don't have to travel, and the fees you have already paid for your tax dollars at work. So please do take advantage of the wonderful opportunity of working with an advisor to help you move your business forward. We are so glad you joined us today. This session has been recorded. It will be shared with you in a few days. Look for an email from Emily. I did post in the chat a link to our survey. If you haven't clicked on that already, please do. We would love your feedback on the information we shared. Is there anything you'd like us to add next time? Are there other webinars that you'd love us to present for you? So thank you so much for joining us, and we hope to see you at a future webinar. Take care.
Thank you.
Have a great day.